Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 30th of June. I'm Daniel Lam, your host for the podcast. Earlier this month, I was playing the newest version of Street Fighter with my son in a shopping mall. It was a free 1-hour playing session of video games linked to the launch of the newest video game console of a certain famous Japanese video game company. That brought me to look at the performance of technology stocks in Japan. After all, our second half investment theme is to trim the excessive exposure in US equities and rotating into other global equity markets. And growth stocks in Japan had a solid second quarter. The growth-heavy Nikkei 225 index outperformed the domestic-heavy Topix index by nearly 6%. Clearly, the clarity factor did help, i.e. the cooling of tariff tensions, and now the subsiding of the risk in the Middle East induces investors to refocus upon the growth themes. Now, there were 10 consecutive weeks of foreign inflow into Japanese equities since the sell-off in global equities from Liberation Day. Japan is enjoying ongoing corporate governance reforms, sustained share buybacks, and reasonable valuations. Of course, there are some uncertainties out there. For example, the upper house elections on the 20th of July could result in volatility in Japan's fiscal policy. But the most watched-after risk is the effect of a stronger yen, which can weigh upon earnings projections. But this risk to us is overblown. The magnitude of yen appreciation is going to be relatively mild. Our 12-month forecast for dollar yen is at 140. The Bank of Japan is not in a rush to raise rates. Yes, Japan's core inflation has been rising for several consecutive months and remains above the BOJ's 2% target. But the Bank of Japan had also stated that they are aware of the continued uncertainties from the tariffs on global growth. Lastly, Japan also enjoys one edge over the US. Its government bonds are mostly domestically held. This is in contrast to the US, where many foreign entities hold US treasuries. Now, we talked about the structural risk in the US and how that may lead to volatility in US equities. This is another point that one should trim excessive positions in US equities and rotating into other global equities, such as Japan's. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.